You've probably heard that 90% of millionaires built their wealth through real estate. That stat gets thrown around on podcasts, at dinner parties, in every YouTube video about passive income. There's one problem: modern research doesn't actually support it. And if that number is wrong, imagine what else people are getting wrong on both sides. Two people can start with the exact same money. One buys a rental property, the other invests in the stock market. 20 years later, the gap between them is big enough to change how you think about building wealth forever. We ran every number, every repair bill, every market crash, every hidden cost. The answer isn't what either side wants to hear. Derek and Sam both have $60,000 saved. Same age, same salary, same city. The only difference is what they do with that money. Derek uses his 60 grand as a 20% down payment on a $300,000 rental property, a 3-bedroom house in a solid neighborhood. He takes out a 30-year fixed mortgage at 6.5%, which puts his monthly payment at about $1,500. He finds a tenant paying $2,200 a month. Subtract the mortgage from the rent, and Derek is looking at about $680 a month in profit before any other costs. Derek can see the house from his car, show the lease to his friends. It feels like a real move. At his buddy's cookout that weekend, someone asks about the property, and suddenly Derek is the guy with the plan. Sam takes that same $60,000 and puts it into a total stock market index fund. He sets up a $300 automatic monthly contribution and forgets about it. When friends ask what he's investing in, he says index funds, and the conversation dies right there. A month later, he checks his account. It's up about $400. He closes the app and goes on with his day. And this is where psychology starts to matter. Our brains are wired to trust things we can see and touch over things that exist as numbers on a screen. Psychologists call this tangibility bias, and it's why Derek feels wealthy on day one, while Sam feels like nothing is happening. That gut feeling is exactly where the math starts to get dangerous. That $680 a month in profit looks great on paper. Then real life shows up. Property taxes on a $300,000 house run about $2,700 a year. Landlord insurance adds another $1,800. The standard rule is to budget 1 to 1.5% of the property's value annually for maintenance, so another $300 to $4,500. Add all of that together, and Derek's annual expenses chew through roughly $8,200 before anything even breaks. That monthly profit? After these baseline costs, Derek is essentially breaking even, and that's in a good year. Year 2, the water heater dies, $1,200. Year 3, a roof leak costs $2,800 to fix. Somewhere in there, he loses a tenant and the property sits empty for 5 weeks while he cleans it up, relists it, and screens new applicants. And here's the part that rarely gets talked about. Derek is managing all of this himself to save on property management fees. That means phone calls at 10 at night, weekend showings while his friends are at the lake, and coordinating plumber visits on his lunch break at work. He's basically running a part-time job he doesn't get paid for. For 3 years, Derek's actual cash flow, after every real cost, sits somewhere around negative $5,000 to negative $10,000. He put in $60,000, and so far the property hasn't paid him back a dime. It's been paying the bank, the insurance company, the tax assessor, and a rotating cast of repair workers. Derek still believes in the investment, but late at night when he runs the numbers on his phone, they don't look anything like they did on the napkin, and that's before the big expenses even show up. Roofs need replacing every 20 years. HVAC systems last about 15. Water heaters give you 10 to 12. These hit in chunks of $5,000 to $15,000. And a single bad tenant who stops paying and knows the eviction process can cost $3,500 to $10,000 in lost rent and legal fees, erasing years of progress in one shot. So if Derek's rental is barely breaking even after 3 years, what's been happening with Sam's money this whole time? While Derek is fielding repair calls, Sam's money is doing something boring but extremely effective. The S&P 500 has averaged roughly 10% annual returns over the last 30 years. At that rate, Sam's $60,000 plus his monthly contributions have grown to about $93,000 by year 3. By year 5, he crosses $120,000. By year 7, he's approaching $157,000. Something important has shifted. The gains on his gains are now producing more new money each year than the $300 he's putting in every month. That's compound interest doing its thing. It's slow at first, then it bends upward faster and faster. Sam didn't pick individual stocks. He didn't watch financial news all day. He opened an account, automated his contributions, and left it alone. That's the whole strategy. On the weekends, Derek spends replacing a faucet or showing the property to strangers. Sam is doing whatever he wants. Now here's where the numbers get interesting. Because at the 10-year mark, the result isn't what you'd expect. Derek's property has gone up roughly 4% per year and is now worth about $444,000. His remaining mortgage balance is approximately $203,000. That puts his equity around $240,000. This is where leverage shows its power. Derek used $60,000 to control $300,000 in assets. The bank put up 80% of the money, but Derek keeps 100% of the appreciation. That 5-to-1 ratio is real estate's biggest advantage, and it's why property builds equity faster than stocks in the early years. Sam's portfolio, with those same consistent monthly contributions, sits at roughly $224,000. At the 10-year mark, Derek is ahead because of leverage, but he also spent hundreds of hours managing the property, concentrated everything into one house on one street, and carried $240,000 in debt. Sam spread his risk across thousands of companies without giving up a single weekend. By year 20, compounding pulls away. Derek's property is now worth around $657,000. His mortgage is nearly paid off, with roughly $134,000 remaining, putting his equity around $524,000. He's collected rent the entire time, but after 2 decades of repairs, tenant turnover, taxes, insurance, and at least one major renovation, the actual profit he kept from all those rent checks adds up to around $30,000 to $60,000. Sam's portfolio has grown to approximately $667,000. His total contributions over 20 years came to about $132,000. The other $535,000 is pure compound growth. Money that made more money. And if Sam had bumped his monthly contribution from $300 to $500, his portfolio climbs past $800,000. In the stock market, putting in more money multiplies through compounding. In real estate, putting in more money usually means buying another property, taking on another mortgage, and doubling your workload. If you're watching this trying to decide where to put your own savings, you might think the answer is obvious at this point. It's not, because we haven't talked about the one thing that matters more than any of these numbers. If this sounds like stocks win easily, there's one massive problem: your brain. In 2008, the S&P 500 dropped 38% in a single year. Peak to trough, it fell nearly 57%. In March 2020, it dropped 34% in about 3 weeks. If Sam watched his portfolio go from $150,000 to $93,000 in a month, every instinct he has would tell him to sell everything. And that's exactly what people do. A Dalbar study from 2024 found that the average stock fund investor earned about 16.5% that year, while the S&P 500 returned 25%. That gap exists because people sell when prices drop and buy back in after the recovery already happened. Over 30 years, Dalbar found the average investor earned about 7% annually versus the market's 10.5%. On $100,000, that difference turns into $800,000 versus $2 million over a lifetime. Same market, same time period, completely different outcome, all because of behavior. Now, before you walk away thinking real estate is a losing bet, hold on. It does beat stocks in specific situations, and if any of these apply to you, the math flips. If you're in a market where monthly rent equals at least 0.8 to 1% of the purchase price, the cash flow math works in your favor from day one. Think parts of the Midwest, the South, and smaller cities where a $200,000 house rents for $1,600 a month. If you use a strategy called house hacking, where you buy a duplex or a fourplex with an owner-occupied loan, live in one unit, and rent out the rest, you can cut your own housing costs to near zero while building equity. That's something the stock market simply cannot do. Real estate also has tax advantages stocks can't touch. Depreciation lets you write off part of your building's value every year, even while the property goes up in value. And a 1031 exchange lets you sell and roll the profits into a new property without paying capital gains taxes. Stock investors don't have anything like that outside of retirement accounts. Real estate isn't a bad investment. It's a misunderstood one. Remember that 90% number from the beginning? A Ramsey Solutions study of 10,000 actual millionaires found something different. 8 out of 10 built their wealth by investing consistently through their employer's 401k, and nearly all of them owned their home. They didn't pick one side, they used both. The real question was never which asset class wins on a spreadsheet. It's which one you'll actually stick with long enough for the math to work. Real estate forces you to stay in because you can't panic sell a house at 2 a.m. when the market drops. That illiquidity, the part that feels frustrating, is actually a feature. Stocks reward patience, but they test it every single day. The answer that counts every dollar, every hour, and every risk is the only one worth trusting. If this helped you think more clearly about where to put your money, hit like, subscribe, and share this with someone who needs to hear it.